So now we know what the central bank is looking at, and also that we should be looking at these things as well. But what happens when a central bank needs to act? What happens when inflation is below a target rate? When GDP slips into negative territory? Well, next we'll be looking at the tools a central bank has and how they use these tools to turn the economy around. Now the first tool we are going to be looking at is also the most important tool, because it is generally considered to be one of the primary things that a central bank uses in order to manage the economy. The tool we are talking about is interest rates. Now, interest rates are generally used to control inflation. So if inflation is increasing too fast, the bank will increase interest rates. This encourages people to stop spending and start saving their money, and hence reduce the rate that inflation goes up. On the other hand, if inflation is very low, the bank will cut interest rates, which in turn discourages people from holding their money in saving accounts and encouraging them to spend, and also encourage people to borrow money which they can then invest. This investment causes the economy to start growing again and inflation starts to pick off. Interest rates are important, and anything that causes us to think that the bank might change its interest rates can provide us some very good trading opportunities. Now the next tool that a bank can use is something called price control. A price control is when a bank tells the market that it desires price to be at a specific level. Sometimes the bank just communicates this and then threatens to act if price moves too far away from the target. And other times the bank will provide very specific price levels and make it clear that if the actual price ends up breaching that price, they will physically intervene and keep it there. An example of this is when the Swiss National Bank had a price floor for the Euro-Swiss currency pair up till 2015. They didn't want the Swiss franc appreciating against the euro, so they imposed a price floor on the pair at 120. If the price went below 120, they would step in and intervene by literally buying up the pair, sometimes buying billions of euros to do this, to ensure that the market would not go below that crucial 120 level. Just think about the kind of opportunity as a trader if you have a central bank backing a trade. It can make for very good trading opportunity with very little risk, because a central bank can essentially print money. But the market cannot, hence the bank will always win the battle. Now the caveat to this is that at the end of 2014, the bank actually removed the floor unexpectedly, which sent the market into chaos as it tried to find a new fair value for the Swiss pair. It almost dropped 40%, so the risks to these types of opportunities are clear. But the point that I'm trying to make is that it is important to understand the tools that the central bank uses and how they can provide trading opportunities. Fixed price controls such as the one that the SNB uses are rare, but less formal versions are much more common, and very often banks will dictate where they would like currency to be, and this actually leads us very nicely to the next tool that the bank uses. Now the tool I'm talking about here is central bank language. As you might have guessed, language is the kind of things that a bank says rather than what it actually does. By making these statements about what it would like the market to do and where it would like the price of this currency to be, the bank hopes that the market will take this message with sufficient threat of action in trading on it. That is why credibility is so vital to a central bank. If a market doesn't believe that they will follow through with its threats if it needs to do so, then the central bank loses its influence and it will have a much more difficult job in dictating monetary policy. Now most of the time this works, but sometimes it doesn't. It is at these times where banks have to step in and act. Now, there's only one more tool that the bank uses, but it has actually been rarely used significantly since the global financial crisis in 2007. Now the tool I'm referring to here is quantitative easing, and the reason it's last in the list is because it is usually viewed as an unconventional policy that many banks only use as a last resort. So what is QE? Well, to put it simple, quantitative easing, or QE as we like to call it, is the process of a central bank printing money and then injecting this money into the financial system. This serves the purpose of stimulating growth and investment. With so much free cheap money around, it also results in the depreciation of the currency since it affects the supply and demand. This currency devaluation further supports its growth as the country's exports become much more competitive, which is much better for the economy overall. Generally, QE is extremely effective, so when the bank threatens it and actually implements it, markets sit still and pays very close attention. and generally the desired side effects are reached over time. Now when a central bank implements these tools, it gives us traders opportunities to make a profit. So all you need to do is to be tuned in with what is going on with the indicator and then listen to what the central bank is doing. This will pay you extremely well to see any opportunities that may arise. Now you might be sitting there thinking it all sounds very simple when you've got all the concepts and you understand that it's the central bank's actions that influence the markets. But you are also probably wondering, how can I figure out exactly what the bank is thinking of doing? Surely this is vital since they play such a big role in the market, and you'll be absolutely right. Now again, this is a fairly simple process because the central bank will very rarely focus on more than one or two specific things at any given time. So this makes it much easier to track and much easier to understand. For example, if the bank is worried about inflation being too low, they will express their concerns, and as traders we will know that there is a good chance that they will cut interest rates in order to combat the falling inflation. And in this scenario, we can actually completely forget about all the GDP and employment because we know that the bank is only looking at low inflation. So we can ourselves focus on this data and also possibly the tools associated with the problem, which in this case will be interest rate cuts. We can then determine how the action will impact the price of the currency and trading the correct way. If we focus on what the bank is focusing on, our trading becomes much simpler. The purpose of this presentation here is to just illustrate how simple the prices are. Focus on the indicators, focus on the bank, and once we know what they are actually focusing on, we can then figure out what tools they will use to try to affect the market.